Most traders never become profitable because they confuse activity with edge. That is the core failure, and it is brutally common. I do not mean they lack intelligence or discipline in some abstract sense. I mean their process has no durable statistical advantage after costs, slippage, and their own behavior are fully included. They are trying to extract money from a game where the spread, the fees, the noise, and their emotions all take a cut. If the expected value is not clearly positive before leverage, it usually gets worse after leverage. That is the first hard truth, and most people never really face it. The market does not reward effort in the way a job does. It rewards repeatable asymmetry. Most traders build a story instead of a system, then mistake a few good outcomes for proof. A profitable month can come from luck, regime alignment, or simply being on the right side of a temporary trend. That is not evidence of edge. Real edge survives contact with different volatility regimes, different liquidity conditions, and different market moods. If a strategy only works when conditions are friendly, it is not robust. It is fragile, and fragility is what kills most accounts. I think the biggest trap is overtrading. Traders feel pressured to act, so they manufacture trades in low-quality setups. That is a hidden tax on performance. Every extra trade adds friction, but more importantly, it adds decision fatigue and emotional noise. The best opportunities are usually sparse, and that scarcity is uncomfortable. People want frequency because frequency feels like control. But control is often an illusion. If you need constant action to feel engaged, you are probably paying for entertainment with capital. Another reason most traders fail is that they do not understand variance. They expect a clean equity curve, and when reality delivers drawdowns, they abandon the method or double down at the worst time. A real edge can still lose money for long stretches. That is not a bug. It is the price of admission. The problem is that most traders do not size positions for survival through the ugly part of the distribution. They size for excitement, not endurance. Once leverage is too high, even a valid strategy becomes a liquidation machine. The market does not need to be right forever. It only needs to force one bad decision at the wrong time. There is also a serious evidence problem. Most traders test their ideas on too little data, with too many degrees of freedom, and then call the result a system. That is not analysis. That is pattern hunting. If you can tweak entries, exits, timeframes, filters, and position sizing until the backtest looks good, you have probably built a curve-fit artifact. The more knobs a strategy has, the easier it is to fool yourself. I trust simple, transparent logic far more than elegant complexity. Simplicity is not automatically profitable, but it is easier to falsify. And falsifiability matters because it keeps fantasy from masquerading as edge. The emotional failure is just as important as the statistical one. Traders do not merely lose because they are wrong. They lose because they cannot execute their own rules when the pressure rises. They move stops, chase breakouts, revenge trade after losses, and cut winners too early. These are not random mistakes. They are predictable responses to uncertainty and ego. The market punishes the need to be right. It rewards the ability to be consistent. That is why many traders can describe a good setup perfectly and still fail to monetize it. Knowing the play is not the same as running it under stress. I also think many traders misunderstand what a real edge looks like. They expect a high win rate, but the better question is whether the payoff structure is favorable after all costs. A strategy can be profitable with a low win rate if the winners are large enough and the losses are controlled. But that only works if the trader can tolerate the streaks and keep the process intact. If the emotional cost of the drawdown is too high, the edge is unusable in practice. A theoretical advantage that cannot be executed is not an advantage. It is a spreadsheet fantasy. The harshest truth is that most people are undercapitalized in skill, not just in money. They want market income before they have market competence. They have not built a sample size large enough to know what works, and they have not survived long enough to learn what breaks. Profitability is usually the result of narrowing the field, reducing noise, and accepting that most opportunities are not yours. That takes patience, and patience is rare because it feels like doing nothing. But in trading, doing less is often the only way to preserve enough capital, both financial and psychological, to let a genuine edge compound. So, when I say most traders never become profitable, I am not making a motivational point. I am making a structural one. The market is a hostile environment for weak process, sloppy evidence, and emotional inconsistency. If you want to survive it, you need a method with real expectancy, a risk model that can absorb bad runs, and the discipline to stop confusing motion with progress. That is a narrow path, and most people do not stay on it.